Let's review chapters 13 through 15. So our first question here says Ortiz Corporation issued 2,000 shares of common stock. What we need to do is we need to prepare the journal entries for the issuance of that stock under the following assumptions. So first, we're going to say that the stock had a par value of $5 per share and was issued for a total of $52,000. Then the stock had no par or stated value and was issued for a total of $52,000. And then our last one, the stock had a par value of $5 per share, but this time it was issued for land that was worth $52,000. So first, issuing 2,000 shares of common stock, stock had a par value of $5 per share, issued for a total of $52,000. How are we going to journalize this? Well, we are receiving cash, right? If we're issuing shares of stock, us as Ortiz Corporation, we're getting cash in return. So we'll debit our cash, and we're issuing stock. So we credit common stock. Now, we're also going to have a credit here of paid-in capital in excess of par for our common stock. So we'll credit that as well. Cash is just that $52,000. That's the amount of money that we're getting in this transaction. Common stock's going to be valued at par value, right? So we're going to take the number of shares that we're issuing times the par value. So 2,000 times 5 tells us that we need to credit our common stock for 10,000. Now, we're selling these shares of stock for more than $5 per share, which is why we have this paid-in capital in excess of par, because our market value is higher than our par value. So the difference of this $42,000, that's going to go in our paid-in capital in excess of par. Our next transaction, we're still issuing 2,000 shares, but this time the stock had no par or stated value and was still being issued for a total of $52,000. So this is going to be a little bit simpler than the journal entry that we just did. We're still getting cash and we're still issuing common stock, so we debit our cash and credit common stock. But since there's no par value or stated value, we can't take the 2,000 times the 5 like we did in the last one, right? So this time around, we just throw 52,000 in there for both of these accounts. Now, we're issuing these 2,000 shares of common stock, but instead of getting cash, we're getting land, right? So here's how this will change. We're going to debit our land account, right? Another asset account, just like cash, so it's increasing with this debit. We're getting land in return for this common stock. So we debit our land, credit our common stock, and credit our paid-in capital in excess of par. The land was worth $52,000. The common stock, we take the number of shares times the par value. We get that $10,000. And we will credit the difference of $42,000 to our paid-in capital in excess of par. Now, question two deals with treasury stock. So Reinhardt Corporation purchased from its stockholders 5,000 shares of its own previously issued stock for $255,000. It later resold 2,000 of those shares for $54 per share, then 2,000 more shares for $49 per share, and then finally that last 1,000 shares for just $43 per share. So what we need to do is we need to prepare the journal entries for the purchase of this treasury stock and then those 3 sales. So first, the purchase of this treasury stock from its shareholders, right? So we bought 5,000 shares for $255,000. How are we going to journalize that? Well, we'll debit our treasury stock and we'll credit our cash, right? Our treasury stock is going up. Our cash is going down by how much? The total cost, this $255,000 that we paid for these shares. Then we're selling 2,000 of these shares for $54 per share. So we still have that information from our purchase because we're going to need that as well when figuring out this journal entry. But here, if we're just selling these shares of treasury stock, we can be thinking of it as getting cash and getting rid of treasury stock, right? So it's the flip of what we just saw in the last journal entry. We're debiting our cash here and we're crediting treasury stock. But notice there is a gap in between there because we're going to have another account pop in between our cash and treasury stock. But let's first figure out those two numbers. So for cash, we're going to take the number of shares that we're selling and multiply it by the price that we sold them for, right? The $54. So 2,000 times 54 tells us that we received $108,000 in this sale. So we debit our cash for that 108. Now treasury stock. Treasury stock is valued at its initial cost. So that's why we need that information from our original purchase of these shares, because we need to see how much we paid for each individual share of treasury stock. So we paid a total of $255,000 for 5,000 shares. If we divide those two numbers, we can see that we paid $51 per share. So that's how we're going to value this treasury stock going forward. It's $51 per share. In this case, we sold 2,000 shares. So we take 51 times 2,000, and we see that that's 102,000. So we'll credit our treasury stock for 102,000. Now there's that difference of 6,000 here, right? So what we're going to do is we're going to credit our paid-in capital from treasury stock for that difference. So in this journal entry, we debited cash to show that we received cash. Then we credited both our paid-in capital from treasury stock and our treasury stock. Now, one thing that we might want to do here whenever we're dealing with treasury stock transactions is keep a T account for our paid-in capital account. So if we make a T account down in the lower right, so far we just have this $6,000 credit to that account. So we're going to want to make sure that that account either has a credit balance or a zero balance. We cannot allow it to have a debit balance. So that's why we want to keep track of it as we go through this problem. So now we are selling 2,000 more shares for $49 per share. So now we're selling these shares of treasury stock for less than what we initially bought them back for. So we'll see how that changes things up a bit. We're still getting cash, right? So we're still going to receive cash in this transaction. So we still want to debit our cash account. And we're still selling treasury stock. So we still want to credit our treasury stock. So let's figure out the numbers, right? Cash, number of shares, times the price that you sold them for. So 2,000 times the 49 gets us this $98,000. So we received $98,000 in this sale. Treasury stock, we know that it's at $51 per share, right? That's what we found previously. We want to multiply that by the number of shares that we're selling. And we get this 102,000 again. Now you'll notice we need to add something over on the debit side to make our debits and credits equal. There's that $4,000 gap there. That's where we now debit our paid-in capital from treasury stock for this $4,000. And that's why we need this T account down there in the lower right. Because we saw that we had a credit balance of $6,000 coming into this transaction. So we could debit a maximum of $6,000 if we needed to. We only needed to debit $4,000 now, so we're okay. So we can put that into our T account to then see that after this transaction, we now just have a credit balance of $2,000 in our paid-in capital from Treasury Stock. So that balance is decreasing here because we're selling these shares of Treasury Stock for less than what we bought them back for originally. Now, we're selling the final 1,000 shares for only $43 per share. Once again, we're debiting cash, crediting Treasury Stock. That's going to be the constant whenever you're selling shares of Treasury Stock. So we can figure out the numbers here. Cash, number of shares times the price per share, and we get this 43,000. Treasury Stock, it's the $51 per share initial cost times our 1,000 shares, and we get 51,000. Now, the difference between our debits and credits here is what, $8,000? So in an ideal situation, we would be able to just debit paid-in capital from Treasury Stock for $8,000 and move on with our life. But if we take a look at the T account down there in the lower right, we have just a credit balance of $2,000 in that account, which means that the maximum that we can debit paid-in capital from Treasury Stock is $2,000. So let's do that now. So we now have debits that add up to $45,000 and a credit of $51,000. So we need another $6,000 still over on the debit side. Where's that going to come from? Well, that's going to then come from our retained earnings. So when you run out of a balance in your paid-in capital from Treasury Stock, you then take that extra amount, the $6,000 in this case, out of your retained earnings. And again, retained earnings is just net income that we hold on to from year to year. So we're decreasing our retained earnings here by the 6,000. Now question 3. Question 3 says on January 1st, Frontier Corporation had $1 million of common stock outstanding that was issued at par. It also had retained earnings of $750,000. The company issued 40,000 shares of common stock at par value on July 1st, and then earned a net income of $400,000 this year. We need to journalize the declaration of a 15% stock dividend on December 10th if the par value is $10 and the market price is $18, and then journalize the issuance of the dividend on December 31st. So remember, a stock dividend is when a company hands out more shares of stock, right? So the first step whenever dealing with the journal entries for the declaration or the issuance of a stock dividend, we need to figure out how many shares of stock are we handing out here as Frontier Corporation. So it's this 15%, right? But 15% of what? So we need to first figure out on January 1st, how many shares did they have? The information that we're told is that they had $1 million in their common stock account, and that was issued at par. So if we remember those journal entries that we did earlier, common stock is valued at par, right? So to find that dollar amount, we took shares times par value originally. We can flip around that equation and say that the number of shares is going to equal your common stock balance divided by par. So 1 million divided by 10. So we can see that at the start of the year, we had 100,000 shares of common stock outstanding. Now, we issued some more shares on July 1st, right? So after we issued those 40,000, we're now at 140,000 shares. And since we're declaring this dividend in December, we're going to base it off of this 140,000, right? So our number of outstanding shares is 140,000. We're declaring a 15% stock dividend. So the number of shares in our dividend will be this 140 times 15%, just 21,000 shares. So we're handing out 21,000 shares in this dividend. Now, how are we going to journalize this, right? We're going to debit our stock dividends. Whenever you declare a stock dividend, you debit an account called stock dividends. If we were declaring a cash dividend, we would debit an account called cash dividends. Right, so that's how we'll start. Then we're going to credit common stock dividends distributable and paid in capital in excess of par. So now how do we find the numbers here, right? So your stock dividends amount will be those 21,000 shares that we found times your market price of $18 per share. So we get this 378. So we can debit our stock dividends for 378. Now, common stock dividends distributable is going to be valued at par. So we take the 21,000 times our par value of 10 to get 210,000. Now, you're paid in capital in excess of par. A couple different ways that we can find this value, right? We know that debits and credits have to equal. We could just take the 378 minus the 210. That would give us what? 168, right? So we could just do that. But where does that 168 actually come from? Right? So your paid in capital in excess of par is taking those 21,000 shares and multiplying it by the difference between the market price and the par value. It's seeing how far above par was the market price when this was declared. So 21,000 times 8 gives us this 168. So that's our journal entry for the declaration of the stock dividend. Then, on December 31st, we need to issue the dividend. So that's when we actually hand out this dividend. So we'll debit our common stock dividends distributable, and we'll credit our common stock. We get the number here from the declaration journal entry. We see how much did we credit our dividends distributable account. That was our 210. So that's what we're going to use here in the issuance journal entry on December 31st. Now, question number 4 says Robles Corporation was organized on January 1st, 2016. During its first year, the corporation issued 2,000 shares of $50 par value preferred stock and 100,000 shares of $10 par value common stock. Then, in 2016, 2017, and 2018, the company declared the following cash dividends: 5,000, 12,000, and 28,000. That's the total amount of cash dividends that they're going to be handing out. What we need to do is we need to figure out, okay, how are we going to split them up? How are we going to allocate these dividends to each class of stock? So how much are preferred stockholders going to receive? How much are common stockholders going to receive? We're told that the preferred stock dividend is 7% and cumulative. So cumulative means that if we missed paying them any amount in previous years, we have to pay them, we have to make up for that in future years. Non-cumulative would mean that if preferred stockholders missed out on a certain amount of cash dividends in 2016, they lose that forever. So, the first step in a problem like this is to figure out how much preferred stockholders are supposed to get every single year. And there's a calculation that we can do there. The annual preferred dividend will be the number of preferred shares times the par value times our percentage that we're given. So 2,000 times 50 times 0.07 for the 7%. And we see that every single year, preferred stockholders are supposed to receive $7,000. Once we have that, then we can allocate these cash dividends each year to preferred and common. So in 2016, we declared a total dividend amount of $5,000. That should shoot up some red flags right now, right? Because we're supposed to pay out to our preferred stockholders a total of $7,000. But we're only paying out a total of $5,000, right? So we don't have enough here to pay the preferred stockholders everything that they're owed. That's going to be okay. So we can look at that $7,000 as every year, the first $7,000 of cash dividends has to go to preferred. And then if anything is left over, then it goes to common. So here, if we're only going to pay out $5,000 this year, preferred stockholders are going to get all $5,000, and common stockholders aren't going to receive anything. Now, this is where it matters that it's cumulative, because we owe $2,000 to these preferred stockholders. That $2,000 is called dividends in arrears. That's just owed amounts from previous years. Right? So we still owe them that extra $2,000. Since it's cumulative, we're going to have to pay them that extra $2,000 in future years. If it was non-cumulative, they would lose out on that money completely. So then we take a look at 2017. In 2017, we declared a little bit more, $12,000. So, preferred stockholders are supposed to get $7,000 every year. They can get all $7,000 here, right? Because we declared more than that. But we also owe them those $2,000 from 2016. So we're going to add those two together. We're going to pay them their $7,000 that they're supposed to get every year, plus the $2,000 that they missed out on the previous year, to say that they get $9,000 here in 2017. Then common stockholders get whatever's left over. So if we're declaring a total of $12,000, giving preferred stockholders $9,000, that means that there's only $3,000 left over for common stockholders. Now, after we pay out these dividends here in 2017, there are no more dividends in arrears, right? We paid out that $2,000 already, so we don't have to worry about that anymore. Which means as we move on to 2018, preferred stockholders just get that $7,000 that they're supposed to get every year, because we didn't owe them anything extra from previous years. If we declared a total of $28,000, paid out $7,000 to preferred, that means that there was that extra $21,000 left over for our common stockholders. Now, question 5 says that Price Company issues $2 million 10-year 8% bonds at 97 with interest payable each January 1st. We need to prepare the journal entry to record the sale of these bonds, and then assume that the bonds were issued at 104 instead of at 97, and prepare the journal entries to record that sale of the bonds. So if we just take a look at the information that we're given in the top line here. Price Company issues $2 million 10-year 8% bonds at 97. That's a lot of numbers being thrown at us, right? That $2 million is the face value of the bond. The 10-year is how long the bond's life is, right? The term of the bond, meaning the Price Company is going to have to pay people back in 10 years. 8% is the interest rate, because every bond is going to come with interest. And then the at 97 corresponds to how much cash we're receiving when we issue these bonds. So if it's at 97, that means that we're going to get 97% of the face value. So anything below 100 is issuing at a discount, because we're going to receive less cash than the face value of the bond. Anything above 100 is going to be called issuing at a premium, because we're going to be receiving more cash than what the face value of the bond is. So let's work on this journal entry here, issuing the bonds at 97. So we're going to debit cash, right? Because if we're issuing bonds, why are we doing that? We're doing that so that way we can get money, right? So we're going to be receiving cash here. And then we want to credit our bonds payable, because we owe people money after we issue these bonds. So your bonds payable, we're going to credit for $2 million. Your bonds payable amount is always going to be the face value of the bond. And we were told that that was $2 million, so we credit bonds payable for $2 million. Cash, we said earlier, was going to be 97% of our face value. So we take the $2 million times 0.97, and we see that we're going to be receiving $1,940,000. Now, there's that difference there of that $60,000, right? So what we're going to do is we're going to debit discount on bonds payable, because we issued these bonds at a discount. Now, another way that we could have found that $60,000, other than just subtracting our bonds payable and cash amounts. We issued these at 97, which is at 97% of face value, which means that we had a 3% discount, right? So if you take $2 million, the face value, and multiply it by 3%, you'll get $60,000. So that's another way that we can go back and check to see if that $60,000 is correct there. Now, let's say instead of issuing at 97, we're going to issue at 104, which means that we're going to now be issuing at a premium, right? So we're still going to debit cash and we're still going to credit bonds payable. That remains constant. And bonds payable is still just going to be the face value, right? So those pieces look exactly the same as to what we dealt with in the last journal entry. What's going to change now? It's going to start with our cash. Our cash, instead of being 97% of face value, it's going to be 104% of face value, because we are issuing it at 104. So we take the $2 million, we multiply it by 104%, which is 1.04, and we get $2,080,000. So that's going to be our amount for our cash. Now, there's this $80,000 difference, right? That $80,000 difference is going to be the credit to our premium on bonds payable. And again, we could find that $80,000 by just taking the difference between cash and bonds payable, or we could take that 4% that we are above 100, right? We're issuing at 104, so we're 4% above face value. So we could take 4% times our 2 million. That's another way that we could have found that 80,000.